We'll go into FinViz. This is the heat map. Let's take a look at ETFs. So check this out. So here, this is the biggest bond ETF, TLT. That's long term. Usually you see TLT, that's long term. What do you think TIP is? Treasury inflation. Yeah, the TIPS, right? I think this is iShares. This is the Vanguard long-term VGLT, government long-term. So this is all government, this is corporate. Oh, here's a BND that does all kinds of bonds, every maturity, right? But these are only long-term. So they have here, they segment into long-term, medium-term, short-term, and even something called extended, which is like way out. And the ones that will have the highest or lowest returns are going to be the ones that in that day probably had the biggest changes in prices, right? And they're usually the ones with the highest duration. So let's look at this. If we look at these here, so look at this, TLT. I don't know if you can read that. Maybe only up in the front there. It says 20+ year treasury bond. Super high duration, 20 years, right? And that's one of the highest returns you see up there. If I look at something shorter, look, SHV, short treasuries, 0.02%, not much of a change. 7 to 10 year. So pretty much as you go from long, intermediate, short, the price just proportionally moves less and less, right? You don't get a lot of price changes on short-term stuff. It pretty much stays the same price all the time, and you're getting your coupon payments or whatever. The long-term stuff, you get your coupon payments, but then you get major price swings too. And sometimes a lot of people don't realize it. Check this out. Let's look at TLT. Let's look at maximum. That does not look like a low-risk security, does it? So if you had a financial advisor say, hey, let's put you in some bonds because they're really safe, right? And let's say that they did that right before COVID or something, right? And so this ETF was trading around 170. And now it's trading around 80s and 90s. You just lost practically half your portfolio over the last 5 years. That's not safe. Long-term bonds are not safe. You're making bets on long-term interest rates. But if you have a specific liability that you have that's going to be in 30 years, and you design your portfolio from the get-go, this is for 30 years, you don't have to worry about those fluctuations as much, right? It's like I'm putting together this bond portfolio, and it's going to be a nice little kitty for 30 years when I retire. Then we'll make the bond portfolio with a duration of 30 years, and we don't have to worry about these fluctuations because it's designed to give us the best return in 30 years. Okay, so that's a lot of the fixed income. Look at this one. Oh, look at this. It's the Direction daily 20+ year treasury bull 3x shares. That sounds like a caffeine drink, doesn't it? So it's trying to get 3 times the return of the long-term treasury ETF. And it does that by buying derivatives, interest rate derivatives. That's what it's doing. Right. So if you're into day trading, gambling, short-term type stuff, that's for you right there. That's why it's such a high return. That's crazy. All right, so let's start looking at how we can use some of this to design bond portfolios. The first way, the easiest way, is just to buy index funds, right? Because most financial advisors will ask you to build a diversified portfolio, a certain percentage of equity investments, a certain percentage of fixed income investments. And a lot of those fixed income investments are going to be like either mutual funds or exchange traded funds. And if we go back to that, this FinViz here, where I was looking at the ETFs. Now, in your 401k and stuff, you're not going to have ETFs. You're going to have mutual funds just because that's how it's done. But here are some of the ones you might have. You might have the mutual fund version of these, but here's a couple examples. AGG, Aggregate Bond Fund. That's the type of fund people might put in their portfolios. BND, that's the Vanguard version. International bonds. Anyway, all kinds of different ones. I doubt financial advisors would put you in the super long-term ones just because of the riskiness. But I know some of the people were hurting and surprised the last couple of years because they thought fixed income was safe. So that's the easiest way to do it. The next one is cash flow matching and dedication. And that's basically what we're talking about with the zero coupon bond. You look at the cash flow you need to have at some point in the future, and you buy today a zero coupon bond with a face value that gives you the amount you need to pay off in the future. It doesn't matter what happens to interest rates. You're going to have enough money because it's the face value. But now we're going to get into the more interesting case. This is the immunization. And so we can build a bond portfolio with all kinds of interesting bonds, maybe ones that have higher returns than those government zero coupon, because they have a little bit more risk, but we can kind of mix and match them. And as long as we set the duration okay, and maybe as long as we buy relatively safe bonds, maybe we're not buying junk bonds. Maybe we'll buy, AAA rated or AA rated bonds. We should be okay. And we won't have to put away as much money now because those bonds collectively, as long as we set the duration equal to the duration of our liabilities, we'll have enough money no matter what happens to interest rates. And so that's the key here. We have to think about what the duration of our future liabilities are. And future liabilities, the key is there, come up with your cash flows for those future liabilities and calculate the duration. And then design a bond portfolio that has a duration equal to that. And then when interest rates do change, you have to tweak your bond portfolio a little because these duration formula we're using is an approximation. It's not perfect. It just makes our job a little easier. Okay, because of this. Because even with that convexity adjustment, it's still not a perfect estimation. It's going to be off a little, and it's going to be off more the bigger the interest rates change. So at some point, there's going to be a cutoff where you're going to say, okay, interest rates have changed enough. Now I'm going to readjust my duration. I'm going to do those duration calculations again of my liabilities and my bond portfolio, and I'm going to buy and sell a little of my bond portfolio to match it. All right, let's look at a hypothetical case. First off, let's look at how we can calculate the duration of a bond portfolio. Okay, so just imagine we've got two bonds, A and B, all right? The nice thing about this portfolio duration formula, it looks exactly like the ones we did in the past. Portfolio returns, portfolio beta, right? We just took the weighted average, and that's all we have to do with duration. We take the weighted average of all the bonds in our portfolio, and we sum them up, and that gives us the duration of our portfolio. So here's an example of 2 coupon bonds, okay? Bond A has a price of 613 and a duration of 5 years. Bond B has a price of 376 and a duration of 10 years, okay? Let's suppose that we buy one of each, okay? So here's the A, this is the 5 year, 5 years to maturity. That's the duration of bond A. And then, and the duration of bond B is 10 years, right? And now when we do these weights, it's how much we have invested in A divided by the total investment of our portfolio, right? And so it's going to be 613, the price of A, divided by the sum of all the bonds in the portfolio. And so that one right there is going to be 613.91 plus 376, right? So that's the total value of the portfolio. That's the weight. Right, and then this is the price of bond B. So we're weighted average, and we end up with a portfolio duration of 6.9 years. So that's how duration works on a bond portfolio. It's kind of like beta or something like that in terms of calculating the weights. All right, so what I want to do now is let's work through an example of designing a bond portfolio to meet a certain duration of obligations that we have to pay off in the future, okay? So let's assume we've got these two bonds right here. We have a 10-year, 10% coupon, okay? We have a 3-year and a 5-year T-bonds. The duration of the 3-year is 2.665, and the duration of the 5-year is 4.051. So remember, usually the duration is a little bit less than the maturity because of those coupons coming to you a little sooner than the end, right? Let's assume we look at our liabilities, and if we calculate duration of those liability cash flows, it's 3 years. So now we want to design a bond portfolio with a duration of 3 years. So what we do is we go back to this formula right here. And we're going to set duration equal to 3 years. We're going to plug in the durations of our different bonds, and we're going to solve for the weights. And that should sound a little familiar if you remember designing bond portfolios to get certain returns when we're doing CAPM and stuff like that. It's exactly the same, but now with bonds, instead of returns, we do duration. So we want a duration of 3 years, right? That's the duration, the main duration right there. And we don't know how much we're going to put in A, but A has a duration of 2.665. And we don't know how much we want to put in B, but it has a duration of 4.051. Remember this right here? The 1 minus WA is basically equal to WB, right? You're expecting to see WB right here. But if you remember from, a couple chapters ago, when we're solving for an equation, and if we have WA and WB in the same equation, we can't solve it, right? Because it's two equations, or one equation, two unknowns, right? And so we do know that the sum of the weights has to be 1, right? So WA plus WB always has to be 1. Our portfolio is always 100%, right? That's what it's saying. And so we can solve for WB by just taking 1 minus, taking WA and moving it over here, right? A little algebra. So anyway, we do that and we solve for WA at 76%. And we know that means that the rest of that 100% must be how much we're going to put in B. So that's 24, right? So we're going to put about 76% of our money in bond A and 24% in bond B, and that's going to give us a portfolio with a duration of 3 years. Let's take a look at the cash flows we get on this bond portfolio. Let's suppose, just to keep the numbers smaller, let's suppose we're going to invest $1,000, okay? Here are the cash flows for bond A. Remember, bond A, we're going to invest it was about 76% of our portfolio, right? And bond B is going to be about 24%, right? Both of them have a 10% coupon that's split twice a year, right? So we get about $38, which is 10% of this, which is bond A. So bond A, we're investing about $760, right? Roughly. And bond B is $240, right? That's how much we're investing. Right? So if this is 760, 10% of that is about 38 times 2, or 76 per year, which is about 38 every 6 months. Okay, so that's where these numbers come from. These are the coupon payments that we're going to be getting every 6 months. And at the end of 3 years, we're going to get our principal of 760, right? Plus our final bond payment of about 38, something like that. There's a little rounding going on here, but that's where that number comes from. Bond B, we bought about $240 worth, right? So we're going to get coupons of about $12 every 6 months. And bond B was a 5-year bond, so it hasn't matured yet. So at the end of 3 years or 6 periods, we're going to have to sell bond B, and this is the price we get by selling bond B, assuming interest rates don't change. Okay? And this is a little bit of an involved example, but it is what it is. So, okay, so those are all the cash flows that are coming to us on our bond portfolio. Now we have to think about how we're going to reinvest those coupons when they come in, right? So let's assume we can reinvest them at the same interest rate. So that's I know it's a simplification, but for now, let's just make that our basic case. This right here is the future value of reinvesting these dividends right here, or coupon payments, sorry. So that's a total of like, what is that, $50 a coupon payment, something like that, right? Every 6 months. And if you assume you get 10% yield to maturity for about 5 more 6-month periods, it'll be worth about $63 in year 5. And so every period, every 6 months, we're going to do that. And so it's worth a little bit less every 6 months. That's the future value, because we're going to get that money later, so we won't be able to reinvest it as much, right? And then time period 6, which is when our liability comes due, this is the total cash flow we're going to get from the final payment of maturity plus selling bond B. We have to sell bond B, okay? Because it's a 5-year bond, right? And so this is the total amount of money we're going to have, 1340.09. That number, 1340.09, is important because what we want to do now is look to see what happens when interest rates change, to see if we have the same amount of money at the end. That's the whole idea behind this immunization. No matter what happens to interest rates, we're still going to have 1340. Okay, and if it works like that, that's great. It's like magic. Okay. So this was our base case, assuming interest rates stayed at 10%. And I'm just copying all the data from the previous slide here, right? Those are all the cash flows that we had. And this is the final number we ended up with. So I went through and recalculated all those numbers, assuming what would happen if interest rates went up to 12%. If interest rates go up to 12%, that means when I go to reinvest my coupon payments, they'll be worth more now, right? And so check that out. That's exactly what happens. Do you see how the coupons, when we reinvest them, they're going to be worth more in the future? Oh, this is great. We're making more money, right? Because interest rates went up. But check this out. Remember, at the end, we had to sell bond B. And if interest rates go up, what happens to the price of bond B? Opposite way. And so that's exactly what happened. See that? It went down. So the price drop in bond B offset the increase in reinvested coupons. And in the end, check out how much we have when interest rates go up to 12%. It's pretty close. It's an estimate. That's why it's not perfect. And that's why as soon as interest rates start changing, they're going to adjust the duration. And that may not seem like a lot. What is that? That's like 40 cents, right? It's about like 4 basis points difference, right? But just imagine if you had a portfolio of I don't know, $50 billion. A difference of $50 billion, a couple basis points there, you're talking about, you know, $20 million or something like that. That's a big deal. That's why they have to keep adjusting, because some of these portfolios are huge. And check this out. So what happens when interest rates drop? So we build our bond portfolio. Now all of a sudden interest rates dropped. So all the future invested coupons, they're all worth less now because when we go to reinvest them, interest rates are lower. But bond B is going to go up in price. So we see that right here. Bond B goes up in price to 250. And look at that. You still have close to 1340. So that's why I call it immunization magic, because as long as you do it properly, your portfolio is immunized against interest rate changes. And the key here, what it's really doing behind the scenes, is it's balancing the changes in reinvested coupons with the change in price of a bond that extends out further than your duration when you need the money. And so they kind of balance each other out. That's what's happening behind the scenes, basically. Here are some active bond management strategies. Income or yield trades. This is basically saying, okay, I want to buy a bond and I want to try to get the maximum yield to maturity. So I'm going to look for a bond with the highest yield to maturity because it has the highest expected returns over the time period, right? But if you keep going up in yield, you keep getting more and more credit risk, right? And so you have to figure out what your ceiling is, how much credit risk you're willing to take. Are you willing to go down to like a triple B bond, the bottom of investment grade, or are you willing to go down to junk because they have higher yields? But then if we go into recession, they're going to have horrible returns, right? So that's what income or yield trade is. Just looking for the highest yield you can anywhere, conditional on how much risk you're willing to take. Interest rate forecasting. So this is where you're going to say, this is what's going to happen to interest rates in the future, right? If you think interest rates in the future are going to go up, that means on average, bond prices are going to go down. So you want to minimize how much your bond prices go down by buying short duration bonds, because short duration is less sensitive to interest rate changes. So you're going to put your money in money markets, in 1 year treasury, stuff like that. Because when interest rates go up and bond prices go down, that short-term stuff's not going to change the price very much, just like we saw in FinViz there. All the short-term stuff, it was just close to zero, right? If you think interest rates are going to go down, which is what I was a little betting on a little, don't copy me though, bond prices are going to go up, right? And which ones are going to go up the most? The ones with high duration, because they're the most sensitive. So when interest rates are going down, bond prices go up, you want high duration to maximize your return from the bond prices going up. Okay? But when interest rates go up and bond prices go down, you want to minimize how much you go down, so you go short term. That's if you want to kind of gamble a little. If you don't want to worry about that thing, either just buy short term stuff and then you never have to worry about it, or just buy a fully diversified bond fund like that BND and that AGG, and they just buy a little bit of everything. Credit spread forecasting. So this is when bonds are rated by some of these credit rating agencies, right? Like S&P and Moody's. What do you think happens if like S&P or Moody's sends out a news announcement or something that so-and-so company is going from a AAA to a triple B credit rating? They're riskier now. What do you think happens to the price of their bond? It's going to drop. And so obviously you don't want to own that bond. So if you had perfect insider information, you would sell that bond before that news came out, right? And just hope the SEC doesn't find you. Sometimes what people do is they build their own models to predict the credit worthiness of the companies, and they trade before S&P and Moody's releases their information, because S&P and Moody's can be a little slow to react, and so people try to predict when companies are going to become safer and try to jump on when there's going to be a credit rating change on a bond before S&P and Moody's. Okay. The other thing here is let's look at the history of junk. JNK. Right, so this is a junk bond fund, right? And you see it's pretty volatile, right? It especially drops when you go into recession. So in a way, credit spread forecasting is kind of like that. You're predicting when the economy is going to get risky, because when things go into recession, get risky, it's the risky bonds that really get hurt. The government bonds are fine. Everybody starts putting money into the government bonds because they figure that's the safest place to be. That and gold, right? And then the last one, I messed up a little. Security analysis. This is where I messed up. Sorry about that. This is where you're anticipating credit rating changes. So if you think a bond is going to get upgraded to be safer, you'd want to buy that bond, because safer bonds are more valuable than risky bonds all in all, right? All right, so that is the end of that chapter.